to the business at hand. All right. Thanks everybody for joining. It's 11 o'clock. I like to start on time. These things typically go a couple of hours or longer. I will be recording it. I've got two attempts. I've got recording with the Zoom to the cloud, which always works, but I like recording it with Snagit because I can get it out quicker. Um, this will be the typical, in some ways, a typical review, the products, but really how I use them for trading. Look at the markets. I think there's a lot to talk about after what we saw in the markets yesterday. Um, it's funny, if you watched my Thursday video, I pointed out how the 13-week new high, new low was at a point where the market was likely to pull back or go sideways. Um, I didn't realize perhaps how much Broadcom's um, earnings and potential AI issues were going to impact on the markets. I think it was overdone, and we'll see what happens on Monday. I think I made a comment in the video I put up last night that I can't wait to see Sunday's futures. I could see it going both ways, but my guess is they bounce, but we'll see. So, welcome everybody. I see a couple of new names, and put your seatbelts on and hope you have a coffee with you or something to drink because there's a lot of stuff going to come at you. There's new users, new people here, names that I don't recognize, so welcome. Trader Sam, congrats on what you're doing with Dan Fitzpatrick. Um, he is one of my favorites, always has been, stockmarketmentor.com. A lot of overlap in how I think and how he thinks. Um, and I remember taking him out to dinner and one day at a Minervini conference when he still did them live. So, all right. So let's go ahead and get started. For those that don't know me, my name is Jeffrey Scott, and my best email is marketmripro@gmail.com. You're probably already members of my Google group, Top Down Trader, and I have a fledgling website. I mean, I'm an old guy. To me, it's more fun to do webinars and post them on YouTube than build a website. But Praveen's put something together, and we'll probably add to it. Um, just start out with the usual disclaimer. This is for educational purposes only. Any recommendations are in the spirit of education, not investment advice. The intent of the video is to demonstrate the tools, really my tools of top-down analysis and how I apply them. Trading involves risk. You and you are solely responsible for any investment decisions you make. Trading stocks and options should be considered risky and you should consult with your financial advisor before making trades. I am going to do my option thing at the end. I've been trading options for 30 years, and so I look at them maybe different than others. We've got two options experts that teach, and Sam and Stacy on this call. So I respect that. I always get nervous when Sam's at a live meeting and I'm talking about options in front of him. But I'm very specific in how I look at options. And I'm a directional trader. I'm a swing to position. I am not a day trader. And I've tried to use options as how I enter those trades because I believe I can do them with well-defined risk and often lower risk than buying the stock. And I also think it allows me to control my stop better or limit my downside than by buying the stock. And I'll show you some of that as we go on. But I really, again, want to emphasize that if you've not been doing options a long time, they are risky. And you should check out the website of the Options Industry Council where they have all kinds of free stuff to help you learn the risks, including the downside risk of options. Again, since this is going to be posted, I know most of you probably are part of my Google group. It's called Top Down Trader, and I'll give discounts from the group. I'll put notices when I put out my videos to a question that I'm going to respond to in a few minutes. I will I will put in the Google group email if there's been an update so you can update your product as well. Talk couple seconds about how we changed the program. Um, and it's really designed to be easier for you. The Windows Store sits on everybody's computer, and it's a vehicle that we can offer limited trials and catch a much broader audience. And it's also a vehicle that Praveen can push out updates whenever they're ready. Now, the question did come in about how do you know if there's an update? So what I've been doing, and just because I'm doing it doesn't mean it's the right thing. Let's see if I can do that. I am going to the Windows Store, which is here, and every day I'm going into updates and downloads. And at the end of the day, I check for updates. Now, I believe it's updating by itself and that's part of the Windows Store because on a couple of my computers that I hadn't touched in 3 weeks because I've been world traveling, they updated automatically to the most current version of the app. So I think it happens automatically, but you can always go into the Windows Store, go into updates and downloads, check updates. And it's probably not a bad idea because a lot of the things that are being pushed to your computer or a lot of the files on your computer, they probably do need to be updated at some point. I'm not talking about the trading app. I'm just talking about your routine Windows files and other files related to your manufacturer. All right. You know, we sort of launched this product, the app, in March, but it's never really been a public launch. I have a very small audience. Why? Because I have a career. I build companies and I sell them, and I'm a physician and I work full time. So I've never kept a big list of people to mail. So it's purely been word of mouth. Well, that's going to change on November 30th. I'm going to be hosted by an existing trading company. They have a 60,000 person mailing list. They do educational programs all the time and they're actually he's a friend of mine and he's doing it really as a favor to me. So that's when the official launch is going to happen. Um, I'm going to offer a discount there similar to Black Friday, which was $14.95. I will offer that to anybody here who doesn't have the program, which might be one person. So that's why I'm not here to sell. If I sell, I think what's new in the latest update makes sense, by the way, Wojtek. If you're interested in the app, email me. It includes the trading view indicators as well. And I mentioned Black Friday event. There's a rebranding and new offerings on the way, and you'll see those again in a couple of weeks as well. So several of you that I see here have come in through Metastack. That's awesome. Um, I've already had some of my existing users ask me, should they buy Metastock? And there's pros and cons. I think there's a lot of pros. And I'm going to show you some of the differences in the programs today and how I'm incorporating them. But this isn't here. I'm not here to sell you anything today. Well, you want to buy some computers, different story. Um, I'm here to show you how to use the tools, well, I can't say how to make money, how I use the tools to make money in the market. Somebody asked me on the Metastock video, which I was a guest and not a host, how to tell them my performance. And I just told them my goal was to exceed the markets by 20% on a good year, and in a bad year in a bear market to lose less. And you know what? I'm okay with that answer. But in a webinar that I'm sponsoring, where I'll take the SEC or whoever risk, I'll tell you my performance and I'll show you. I didn't redo it after yesterday, but I did check this morning. I made the slides before it was updated. It really didn't change much yesterday. It's been a good year. I wasn't kidding about the computers. I have a disease, and my disease is I buy whatever I want. and I end up getting way too many things that I need. On the left are 8 computers that I'm not using right now. They're all 2025 models. I get the maximum configurations. Some like the Asus ROG X1, I think it is, the Razors have extended warranties. They're all restored to factory state. Those that have bought my computers know that they're high end, they're in great shape, and I load them with stuff. So you can delete the stuff if you don't want it, but it's way exceeds the value of the computers. I sell them if they're the same year, they're usually about 40% less than what I paid for them. If they're a year old, which none of these are, it's 50 to 60% off of what I paid for it. And I haven't had a lot of complaints. So email me at marketmripro@gmail.com if you're looking for a great trading computer. And it says gaming because they turn out to be some of the best trading computers. So just background, I am a cancer doc. I'm board certified in medicine, internal medicine, oncology. Been trading since the 90s. I quit practicing in 2001. I am in, depending on how you count, the fourth or seventh startup. Four, I've been very actively involved in a couple. I've just been a peripheral player. I've sold companies to AmerisourceBergen, now known as Cencora, Cardinal Health, Magellan. I've been part of a company that was sold to them. It's now owned, I think, by Prime, and I think Prime got bought. So that's where I spend my time. My current company is called Integra Connect. It's a healthcare data and informatics company. We spend our days helping make doctors better at what they do by identifying gaps in their care. And medicine is moving so fast that it's ridiculous to think that a individual who's been out of training for more than 5 or 10 years can keep up. And so we can help them using technology, but I can't be by my computer trading during the day. Hey, Bill, good to see you. So out of necessity, I learned how to do a trading regimen or style that allows me to be happy with my results and not sit at a screen all day. And I've been teaching it to people for a long time. I still am active in cancer research. This is actually from December of 23, where I actually got lead author on a publication in one of our most important journals. So that's for my mother because she's pissed that I don't practice medicine anymore. But hey, I can impact on a lot more patients by helping doctors do better. I met this super smart guy in the mid 90s. His name was Ian Woodward. As I look at the list here, probably half of you were in those same meetings that I was in Palos Verdes Estates. Ian, Ian is a gem. I mean, he is an incredible, was a gem, incredible teacher, brilliant. And I love how he used to say in his British accent, and I'm not going to try and reproduce this, that I'm not a guru. I will teach you to become your own guru. And I really believe that he ended up creating a lot of really good traders. I've explored multiple educators. I've bought every program that you can imagine. I've read, I go to seminars. And so I basically like to think that I took that, smashed it all together with the core of Ian and added to it. And that's how I trade today. And I built, or I had some of these tools built for me. I couldn't code a game of tic tac toe by myself, but I built these tools, the Market MRI suite of tools, to help me implement those learnings and to shorten the time necessary for my market, industry group, and stock analysis. There are more important things in life than trading. And now she's 4. This is when she was 2. And yes, Stacy, it is a dark time for University of Michigan football. What a disaster. But we'll come back. And but that's my granddaughter. I've got 2 grandkids. That's me. Probably look about the same. I've had a lot of folks. Yeah, it was pretty sad. I mean, to see a guy destroy his career, um, it's just horrible. Um, I've been really fortunate to have met and listened to, read, attended sessions from a lot of smart people, some of which you know, some you probably don't. But Ian Woodward is right here, and I mean, he was a gem. Um, a gem. He retired from Xerox. He would talk about that he had one stock in his portfolio, which was Xerox, and he was told by one of his friends that you have to diversify. And so Ian basically diversified, and by listening to O'Neill on the radio, reading everything O'Neill had, and then, being an engineering type mind, Ian was able to make things better. And I believe he made them better. If you haven't read O'Neill's books, shame on you. How to Make Money in Stocks to me is a Bible that I read every year, and I always pick up something. Do I trade like all the O'Neillians? No, I trade my way, but it's a foundation. Morales and Catcher, I actually am friends with them. Um, Both worked for O'Neill and managed their money, and they, I think, improved upon what O'Neill did. Minervini is, maybe he's the most well-known of applied O'Neill style of trading, a little bit of his own twist. I miss his South Carolina meetings. They were ridiculously expensive, but probably worth it. My friend John Person, I bought his indicators probably in 2011. I moved to Florida in 2013. I knocked on his office door and quickly became friends. And actually, we're having dinner tonight to celebrate my wife's birthday. He's an author. He's got indicators and Thinkorswim that we all get access to. Great educator. He manages money professionally, and he's actually my friend. And we launched a new product on my platform of his tools. It was sort of like I did in March, a paid beta, people to use it for a month and try and break it. And again, there's a lot of rebranding in the names that you're going to see of the tools. But his tool will probably be more widely launched at the end of the month. He's got a number of webinars he's going to plan. Van Tharp, this guy would talk about throw darts at a stock list, and doesn't matter what stock was hit, but how you manage them, stops, targets, when you take profits. I think that's very important. Rob Hoffman, a lot of thanks to him because he sort of started me on the journey from being the guy listening in and watching the seminar to actually giving it. I mean, I've always enjoyed speaking at the podium. I remember on one of the first webinars I did for Rob, there were 7,000 people on the Zoom. And to say it scared the bejesus out of me would be an understatement. It was fun. Um, and my tools are in wealth charts, some of my tools. Roy Kelly, who's retired, had just an interesting way of looking at trading, and still have some of his things that I incorporate. George Lee, who, like Ian, is no longer with us, nor is William O'Neill. George Lee, just a great person, a great trader, and I've met many of you through George. The reason why I've kept that Orange County meeting, or tried to keep that Orange County meeting, and to keep it cheap in the $300 to $400 ranges, because that was George's legacy. George was the trading educator for the common man. He brilliant, great grasp of the market, his own approach. Would yell at people in the audience because he'd tell them to buy Netflix and they didn't buy it and went up 30%. But boy, he was a great guy and he sort of missed. And then over here is Sager. If you buy the Metastock app, which means you also have to buy Metastock data, you ought to be looking at his tools. And I'll talk about that some today as well. So I'm a top-down trader. I'm swing to position. I look at daily and weekly charts. Yes, there was a time in my life when I looked at futures and ticks and minute charts, but that's when I have non-competes and I can't go out and hold a regular job. Um, if I'm working, I'm not day trading. And one thing that I've learned from a lot of these masters is they often have rooms that look at futures and short-term trading, but their big money is made by trading in a longer time frame. and trading equities. I use indicators and scans to help me find my setups. I trade equity and equity options. I look for stocks in an uptrend, pull back to support, and buy them on momentum off support. And my tools are built to help me find those stocks. Um, if I don't cover it enough in seminars, but that Van Tharp stuff, rules-based position sizing and stop management. I have cash right now. I still have positions. I have puts on several of my positions that I put in when I saw that the short-term indicators were saying we're going to pull back. And therefore, yesterday was not as painful as it could have been. I like seasonality, but I think technicals trump seasonality, and the macro has been such a strong influence on the markets this year. I'm not sure seasonality holds up as much. I'll show you tools that I do it in 30 minutes a night, and I haven't changed my basic approach in 30 years. It's just the tools make my life easier. Now, this is an ancient Ian slide, and I talk about it all the time, and I bet everybody here's heard it 30 times. The gist of it is smart people trading once a month, giving a list of stocks. When you look retrospectively, when the market's strong, they could double in a month. 20 days is basically a month, and 106% gain is a double. Now, who believes that's even possible? Well, it is possible. All right. And in a bad market, the same people did crappy. So it's not just being a good stock picker and knowing how to trade. It's knowing when to be in, when the wind's at your back, as Ian would say, you attack. And when the market's weak, you have to stay on the side or go short or buy contra ETFs. The other message here is look at the wins. They got less and less over time. Take profits. Of course, nobody wants to miss the APP or the MicroStrategy or Netflix when it starts a run and you end up making 50 bucks, $50 move on the trade and the stock moves 400 points. Man, you feel like an idiot. I'd rather say I made 50 points on a trade, and I'll always leave a small position after I take profits once or twice and let it run so that if it crashes, I can say, I made money on the trade and I put money in the bank. That's what I live off of, or I will live off if I ever retire. And I leave that 20, 30% of my position intact running, and it's the bank's money. If it blows up, I still put enough money into the bank already by taking profits that I made money on the position. And no one says if I make a mistake and I should have held on to APP or Netflix or MicroStrategy. By the way, I'm not recommending any of those right now. I can buy them back. You never go broke taking profits. Does my style of trading work? All right. This is the first year I've ever actually shown my portfolio, and I did it for a reason because I knew I was launching a product. Um, I've always, I do a video every week. You can go back 20 plus years, and I talk about what I think the market's going to do, and I give you some stock ideas. Do they work all the time? Heck no, but they work more often than not. So I never bothered to show an account statement. When I would do my live meetings, I might show an account statement, but what I typically would just show you are some of my best trades. But like I said, I make market direction calls every day on my webinars or on my videos, and I always talk about the stocks that I'm thinking of trading. And that's key. I'm thinking of trading. It doesn't mean I'm going to trade them, and I'm not guaranteeing that they're going to work. So these calls are archived, so anybody can look at them. Plus, I'm also going to tell you, even though I'm going to show you a snapshot from the Schwab website of the same account I've been showing you for 6 months now or longer, don't trust anything anybody tells you over the internet. I could have 12 accounts and I'm only showing you my good one. I'm not, but how do you know? And take everything that anybody says about performance, including mine, with a grain of salt. There's more to performance than being on the right market direction and instrument. It takes a trading plan, and do you have one? And most people that come to my seminars don't speak up and tell me about their trading plan. What is your setup? What is the signal to go long or go short? How many shares are you buying? Where is your stop? Do you have targets to take off profits? What do you do with your stop after the stock moves? How do you put your holdings into the context of what the market is doing? That's all a trading plan. And if you don't have a trading plan, then you're probably changing those answers on every trade. That's not how you make money long term. And again, I'm going to show you some performance slides, but there's no guarantee or warranty that use of this, my tools, my products, or anybody's products will generate the same results now or in the future. Now, like I said, I put things out there, and by putting things out there, I can actually call them up and say, I told you this. It's not, I'm not being George and trying to make you feel bad, but that was his style and it was effective. But how can I prove? Well, I got documentation. On April 7th, my a bottom is in. Now I originally left it as that. And then before I put it out to strangers on YouTube, I added who knows if it is the bottom. But on April 7th, there was an obvious bottom in that US markets. And for me to put out something like this, it has to be obvious. And I'll tell you, there's somebody out there who I'm friends with who works for one of the major trading education programs and talks about his 100% performances, and they're real. And he's a super smart kid. He's young, but I remember in March of 2020, he called me up and he was lamenting about what was going on with his portfolio and his family's portfolio, and he was losing confidence. And that was kind of like a day before the market bottomed. And what I've learned is I live for bottoms because 2009, 2020, and 2025 off the bottoms are multi-100% returns. Remember I showed you that slide that said 20% return or 100% return in a month? That is what happens when you get to major bottoms. If you identify them, you can take advantage. So in 2025, I got busy at work. I've been to a wedding in India. I've been traveling like a crazy person. So I moved most of my net worth to money managers. I've traded 7 and 8 figure accounts of my own money in the past. It's very different than trading a smaller account. I wanted to show I could trade a smaller account. I'm getting close to an exit. I had some health issues in 2024, which are gone. I'm doing great. Plus, I was able to convince my wife because of the health issues to let me get a nicer boat. So there was a benefit of having a problem. I got grandkids now. I want to spend time with them. So I gutted an account by moving everything away to the money managers, and I left just shy of 150,000 in cash and assets. And that's what I wanted to prove that I could double it in a year. Um, I doubled it in July and I added 500,000 more to the account. This is the same account. Just go back and look at my prior slide decks that I've talked about. This is the only account that I'm actively trading. What does that mean? It means I got 2 positions that haven't changed in TradeStation and account to get the free data. And I may have 1 or 2 in Tasty Trade that I haven't traded. I just leave there to keep the account active. So this shows you that I started the year, and this is through July 11th. And why do I have this here? Oh, because this is when I doubled. When I took the snapshot, I was up 94.37%. I started with 149,000, and the point of this was I added $500,000 more. Now the truth is, I didn't really add 503,000. I had a margin call earlier in the year of 3,000 that I put in, and then I added the 500,000 in the beginning of July. So you could see I started the year off fine, and then as the market sold off, I was negative, as were probably many of us. And I hate giving back my gains. April 7th or 8th is probably right here. And that was the end of the negative. So I added money to my account, and there's nothing wrong with a 94% return. And I'm willing to do drawdowns to get a 94% return. And that's an annualized return. So what happened since? Here's through Thursday. Here's my equity curve. I'm up 198.98% year to date on an annualized basis on the same account. I wanted to see if I could double it a second time. I still got a little bit to go, but I'm going to get there. And you could see the investment change. Now, that's great. All right. Look at this move on the equity curve. Look at it from when I turned positive, or really from the bottom of the market. Well, what if I was sitting out until I made that call that we had a bottom? Well, it's up 407% since the bottom. So April to May to June, July, August, September, October, November, December. So we're at 8 months. And so that's 50% per month. But I think we can see that the majority of it was done in the first 4 or 5 months. Um, and it's been sort of going nowhere since. Um, this has been a great year. Is it because I'm great at what I do? No, I just do what I do and I have a trading plan. It was the market. So I use options for leverage. I want low cost spreads with limited downside risk. I have to use margin because some of the option trades require us to have margin. I avoid big losses. That's how I design my spreads. I don't chase shiny objects, and I'll scale up and down my cash reserve based upon market conditions. I want, as the market is dropping, I want to be starting to deploy cash when we get close to a bottom, which means I'm not going to hit the exact bottom. And when the market's going to new highs, I want to be taking profits because eventually you start falling. So I want to have my cash going up as we get extended to the upside, and I want to be deploying cash as we're getting extended to the downside. And so I use my timing model to help me do that. I have my trading plan, pull back uptrend, two Momo dots, which we'll talk about, and weekly HCDs, which is my favorite John Person setup. Keep position size and stop management on options the same as stocks. Everybody wants me to say, and every other educator to say, that options are dangerous. Well, they're dangerous. When are they dangerous? They're dangerous when you have a position size where you're an idiot. I've been that guy. All right. So you have to know what you're doing. Position size can kill you. Um, I don't do revenge trading. I roll my winners up and out, and I don't do FOMO buys during work time. I did those when I was young and dumb. And I bought the thing that was shiny and breaking out and moving, and the next day it pulled back. And the benefits of a smaller account, although people would argue whether 150,000 is small, sleep better at night, don't worry about futures, less anxiety. And again, I should take this picture out because he just got deposed. That's the old coach of Michigan. But I'll tell you, I mentioned I had a health scare in 2024. And I've never had a knife on my body except in my mouth. And I had surgery scheduled on a Friday. And I'm a workaholic, so I was in dinner taking customers out on Wednesday. And my wife was going to kill me because if there was a delay getting back to Florida and I missed my surgery, she would have thrown me out of the house. And so I'm sitting at the Teterboro, which is a private airport that we use in Manhattan, waiting for my jet to be refueled to take me home. And I see all these people wearing Michigan garb, and the new coach of Michigan, no longer there, sat down next to me, and we talked about where I was going and what was going on, and he really pumped me up, and so I appreciate that. So regardless of what's happening to him, it helped me get through a rough time. But I want more time for my grandkids, for my lovely wife, my boat, and so that's why I do this. So let's talk about the platforms and then dump into using them and showing what I do and trying to help you become your own gurus. There are a number of programs out there that you can use that you can duplicate a lot of what I do, either through purchasing of additional tools or built in. HGSI is really Ian's program. Ian was the brains, George Roberts was the proprietor and the owner of the product and who employed the programmer Matt. And then there was a guy named Gary who was the data provider who ultimately folded the data into George. Most, but not all of what I do can be done in HDSI. It's a low cost program. It's probably $7.95 or $8.95 a year. I still subscribe to it. And to be honest, if it was easy to use, then I probably would not have gone and built my own product. And that's the only issue I have with HDSI. There's a learning curve. Ron Brown is a machine. I can use it in my way almost as good as Ron Brown. But there's a lot of people that see this and then do this. I think it's a great program, and much of what we do is built in, and you can even get John Person's tool set as an additional add-on. TradeStation's a trading platform. We built an app in TradeStation which allows me to do the scanning and probably better, frankly, than Metastock or even the Market MRI Pro because I can incorporate Sagar stuff and John stuff into it and come out with, again, I like to smush the stuff together and have my own way of doing things. But it's 32-bit. It's ridiculously unstable. I have to restart TradeStation multiple times to go through my scans. And frankly, I'm tired of it. But it does have lots of educators that support it. And as I mentioned, Sagar and John have their tools. TradingView, great platform, stable, relatively inexpensive with data. It now supports direct trading into a lot of brokers. It is a great product, but their scanner is a work in progress. And Sagar stuff's not there, John stuff's not there. But if I basically Praveen has duplicated all my tools from a scanning perspective inside TradingView. We link the TradingView chart into Market MRI Pro, and therefore, in people who buy Market MRI Pro, you end up getting the indicators for TradingView as well. Metastock, I'll talk a little about today. It is sort of the granddaddy of analytics platforms. I've had it since the DOS days. There's reasons why people use it. It's got data for international. It's got options data. It's got this thing called Explorer, the scanning tool, which is really good. It's got a lot of other educators put their tools in, so you can get Sagar's tools for Metastock. I think the big driver of it is stability, familiarity, and the access to data ex-US. And then we've got my platform, which Praveen built. And Praveen was an audience member, and we started working together. And I can't believe that one person built the Market MRI Pro platform and really did it in 6 months of back and forth with him and I reviewing things. So John's stuff, as you saw for Black Friday, is going to be available, and it's available as a freestanding product, or will be at the end of the month. And we have the ability to activate his scanner and his indicators inside the Market MRI Pro product, so you can combine them or separate, however you want to do it. The Market MRI Pro was basically built by Praveen together with me to basically allow me to go quick and to reproduce my workflow. Sagar's toolset, superiorprofit.co. I'm going to show you some of his stuff as we start looking at the markets and how I use them. And John, personsplanet.net. I think .com works, but when I put in .com, it took me to .net. So the Metastock, it's still on sale. It's a much lower price product than the app. Why? Because I provide the data, you got to buy it at Metastock. And I don't have Indian data. I don't yet have options data. And I've tried to reproduce as much of the app as possible in Metastock. And I do like the explorations have things that I don't have. So I used them both last night, and you're going to see that as we go forward. So my key principles, top down works best for me. Market direction is the most important. I want to find the leading industries and buy stocks in them. The leading industries will lead for longer than you expect, and find the best stock in that leading industry. I make the most money by holding positions over a longer period of time. Well, how do I hold over a longer period of time if I'm an options trader? Keywords are up, and out, up and out. And we'll show you that as we go forward. Markets are never wrong. Opinions are, mine are wrong sometimes. Everybody's are wrong sometimes. Um, Money management stops, targets, and size, and it's never different this time. Old Ian slide, and I love it because it's so true. I think of myself as the young trader having a great 3 or 4 months. I'm on top of the world. It's kind of like you roll the dice and chutes and ladders on this side of the pond. Snakes and ladders in England would never work in the DEI and other things of the world that we have in this country, and protecting everybody from bad things like snakes. Speaking of protection, last night I went to bed and I always do the check out the videos around my house because we had a burglary about 18 months ago and found a bear in my backyard. Glad he was there at night, not during the day. But you roll the dice and you're so excited because you land on 20, 26 here or 28 rather, and that takes you up all the way to 84. And think about a big bull market like we've had since the April 7th low. And you're not changing your tactics. You roll the dice again and you hit a three and you're right back to 24. The ladder was great. The chute or the snake, not so great. You can't play chutes and ladders or snakes or ladders with your retirement money. You got to watch your capital. That's why I always have cash. It goes up when the market gets extended, and my cash goes down when it's extended to the downside because the market's going to bounce. I talked about market context. The market's 50%, the industry group's 20 to 30, the stock's only 20 to 30. The market determines my stance, long, short, or in cash. I'm not a great person at going short because I don't like things that have infinite possible losses. Um, that said, I love contra ETFs because they feel like I'm going long and they go up when the market goes down. So I will typically, if I think if we're in a bad market, I'll have mostly a portfolio of contra ETFs. I have option trades designed around them to reduce my risk. So I'm looking at the market. If the market says go long, I want my favorite setups in the top industries. Bottoms up is the I can't help myself. I want the shiny objects. And I use different tools to gauge what's working. So the first Ian tool, and this is not an Ian tool, it's an Ian slide, but it's a Jeffrey, Bob Meager, Robert Minkowski, David Steckler, David Bellardi, and I'm sure I'm missing somebody. We were tasked, Manu Kapadia, how can I forget Manu? May he rest in peace. But we were tasked with a job by Ian to come up with a trending timing indicator for the markets. And we came up with the Bongo, simple indicator. We have three different Wilder RSIs, and we look at the order of the different period ones. We have price versus an SMA. And the first day that both of those happen, or the first bar, that turns a long signal. The first bar that the opposite happens, it's a short signal. And then we look at how long it's been in a direction. Simple, simple, simple. It actually works. And so I've incorporated that as one of the two components of my timing model. I wanted to make it better, and I'll show you what I did. But if that's the case, then I could look for things and say, hey, if my weekly, in this case it's on top, is long and my daily goes red, what is that called? Oh, that's a pullback in an uptrend. Huh. What are my favorite setups? Pullbacks in an uptrend. So I can use that to scan for my favorite setups. You can flip it and look for retracements in a downtrend. Those work for me. Weinstein wrote this great book, Stan Weinstein, Profiting Secrets for Profiting in Bull and Bear Markets. He was all about stage analysis. You want to be long early in a stage two, and you want to be out in a stage four. There you go. That's the whole book. All right. I think it was in July that we looked at J and J, and I looked at it again today. Wow, it has done well. So what this little jagged pattern is a stock chart, and every stock will go through that. I don't care what time frame, tick, minutes, daily, weekly, monthly. In an uptrend, you're going to do this, and then instead of going down, you go back. and you keep doing that. So I want stage twos. And there are actually scanners in the market, and I bet my buddy Praveen could figure out how to do that, that will scan for a stage two or a stage four stock. But one thing that I learned about him is he used a 30 period moving average. I said, oh, maybe I should use that. So um, I can define stages with my bongos. Stage one base is consolidation. The daily and weekly are going all over the place. It's obvious, it's flat. Stage two breakout, the weekly is going to be long. And when you get a pullback in an uptrend, you're going to have the daily go from short to long. And when that happens is my trigger to buy. Topping market looks like a stage one. You don't know if it's just pausing within a stage two breakout and going higher, or it's consolidating to go lower. So it's trending indicators don't work in a choppy, flat market. That's why green to red, red to green, you don't know what it's going to be. But when that breakout occurs, your weekly bongo is going to tell you to short, and your daily is ultimately going to go short as well. Short, it'll go short first. The weekly will take a little bit longer. And then that retracement's going to be, I get a buy signal and then flips to a short. If I'm looking for the stock that's, well, I guess I can actually draw. Stock's gone down, it's moved up, and then it's breaking down. How do I find it right here? Well, the weekly bongo is probably still short because we're still in a downtrend. The daily bongo was long, and now it's turned short again. So if I can figure that out, then I can actually start to scan for those signals. I think I have to erase them. And I didn't actually, oh, I bet if I hit that, clear all drawings. All right, it worked. Cool. All right. Yeah, I didn't mean to leave this in. When I launched my app, I created this slide because my app is expensive. It retails for $19.95. On January 1st, it's going to 2,500. Why is it going to 2,500? Because it's expensive as heck for me to maintain. It requires licenses that renew. My server costs have gone through the roof as more people have joined, the data costs. And you know what? It's worth a lot more. I've bought every tool in the marketplace, and I'm going to raise it, and we'll see as I go to the larger audience. But it will be available at that $14.95 until the end of the year to you, because you're here, and to those people that come on the webinar. And why is it expensive? It's because an indicator, you code once and forget it. You only have to update it if the platform changes. You have no ongoing server, software licenses, data. You don't user support. You don't have to fix splits. It's a pain in the Yiddish word tuchus for what you sit on to have an app. But I can control the app. I can control the workflow much better. So let's just go into the program. I'm going to share the PowerPoint, and what you're going to see in the PowerPoint are just examples. The Metastock is the only other version where I hard code in the buy sell signals in the timing model. So I have the weekly timing model. This is what it looks like in Metastock, and the timing model down here in the bongo on top and the WMA. Oh yeah, my timing model, I took that bongo weekly, and I'm thinking the bongo weekly is going to help me a lot as to what the trend is. And then I'm filtering it with a 30 period WMA. And that is my timing model. So both the Metastock version and the Market MRI Pro app don't make you try and figure out what it is. It tells you what it is, which allows you to look back in time. And this is the one right now. It's still bullish on the weekly. Same thing on the daily, and we turn bearish. We'll talk about more about this in a second on the Qs and what that means. I have it in I remember wealth charts. I got to remember the names of all these platforms. Um, and I just took examples of some of these bad markets, and just you could just look yourself at your own convenience because I'm going to share this PowerPoint with all of you in the top-down trader group. It'll be in the post that I put in later this afternoon. But if you look at crossing over the WMA when the bongo is green as a buy signal, you get in early enough to make a lot of money in the markets. Do I wait for that to enter? No, I do not necessarily wait to enter. Will I commit all my funds right away? No. I start committing funds when I think we hit a bottom, like on April 7th. If I start having stocks go against me right away, I stop because we haven't hit a bottom. But what I find is that breakouts start to work really well after that bottom is in. When they fail, there's not a bottom. But once I get to the buy signal, I'm all in. And you can look at various big market pullbacks. It works. I use a lot of breath tools. So for those of you that are Metastock users, I don't have these all plugged in there. I have asked them to do it. Sager has it in his. He learned it from me. I learned most of these from Ian. Um, and my goal is to get these into Metastock as well. In Sager's tools, you have to download the data to your desktop and then run a tool called Fire to create some of these. And I'm only going to put it into Metastock if they can hard code it. So we'll find out. You can use the timing model for sectors. And let me just stop this here and call out something Praveen did that's incredible. Somebody wanted some of my layouts. Here's how easy it is now to share a layout in Market MRI Pro. Pick the layout you want to share. So that's the sector timing non-ratios. And Praveen needs to help me fix this because there was a split in technology that isn't showing up right on the chart. And I don't know if I have to, well, let's just see what happens if I put XLK in again. And if it works, I'm going to feel like an idiot. I think, no, it's still not working. All right, so we're well aware of this, and it's just something that we got to fix. It's just a split adjustment. But let's say you wanted this layout and you asked me for the layout. All I have to do to share a layout is click the hamburgers, go to new layout, find the name of the layout I want to share. This layout is called sector timing non-ratio. The same thing that you should see on the PowerPoint when I go back to it. So I find it here, and you notice it's got a shared ID. If you copy that shared ID and type it in right here, and then hit copy shared, you now have the layout on your computer. And it's now a part of your program. So if you want the sector timing model, there's a shared ID. The sector strength ratio charts is another way that I look at sector rotation. I look at the market ETFs with the various moving averages and stuff. I'm just showing you what's in here, and now I'm going to go jump in the program. But there were three layouts that people were asking me for. They were asking me for the sectors, my key stock timing, and my market breadth, new high, new low 13. These are all, there's nothing super duper fancy special. They're just things that I coded or I put in, and I use them every day. So guess what? Market breadth analysis 2, which is what I'm going to rename this as. It has a shared ID. It's in the PowerPoint. And the market timing model also now has a shared ID and is in the PowerPoint. So you'll be able to recreate these in 2 minutes on your own. And again, you click on the hamburger and then you new layout, you type in the numbers. Now, for the Metastock users, don't worry. Just ask me. And if I use the Metastock layout, I just have to send you the layout. Not so tough. All right. Just talk about the Market MRI Pro and how I approach the markets and start to look at the market we're in. And a lot of this will duplicate what I put out last night, but that's okay. The daily briefing is, I guess you have Quote Center in Metastock. But I asked Praveen, for a real-time tool that would give me a ton of insight. And it gives me insight already. I picked these ETFs. Ah, good, Randy. So hopefully it worked. I I picked these ETFs. I've asked for being to open it up so you can put whatever ETFs you want in, or stocks or indexes. It doesn't matter. And then I always rank by 1 day close. I will right click in that box and hit best fit. I wish that was a default best fit. That's been an issue we've had with the platform that I'd like to see rectified someday. Up here are new highs and new lows. I'm not sure if this is updating during the day. Here are three indicators or three indexes, the S&P 1500, the NASDAQ, and the NYSE, and what percent of sectors are up today versus yesterday, industry groups today versus yesterday, and percentage of advances. I think this is as good as an interpretation in the market. The other great way requires metastock data. And if you are buying my tool, whether you are or not, if you have metastock data, buy Sagar's Q Divas. I think it's like 99 bucks a month or something. Because you can have this spreadsheet up and I'll use it for other things as well. But it tells you real-time sectors, industry group, and stock advances. I'll talk about my buckets in a second. It's a great tool. And in fact, if you want to look at sector rotation, you could see which sectors are moving, have the best pace, moving the most up. And real estate utilities were two of the leaders and fast movers. You could highlight those. You could, I don't even know, I just hit the love, the heart, and I go to the gears and it shows me the industry groups there. I might do the same thing, and you can do this intraday. And then it's going to rank by what's moving and maybe look at the top 5 or 6. And then I go and I hit this and it opens up the stocks that are there. And then I'll hit the 3 stars and see if he's got some undervalued, good looking stocks. And these come right up from those industry groups. So I don't, I don't even think I can do that as fast in Market MRI Pro. That's limited to the S&P 1500, but it's a great tool. Here you have the same information on the S&P 1500, the NASDAQ, and the NYSE. I don't think Sager is going to have his stuff in any other platforms. He's a new dad and retired, not retired, but living a life where he gets to trade full time and enjoy life. Because I've asked him multiple times to build it into Market MRI Pro or another platform. Not going to happen. But how valuable is it during the day to know what percentage of the stocks are advancing and how it's changing over time? If the market's up and these are low, I know the market's pulling back. If the market opens up lower and I start to see the advancing stocks start to increase, I know the market's probably going higher. Knowing the participation of sectors and industry groups, this is all great real-time breath tools. And then over here, you've got the S&P sectors, S&P 500 sectors. And again, the same thing, 1 day change, and I hit the best fit, all columns. Down here are a number of themes. I hate cannabis stocks, but boy, they were up 50% because Trump said we're going to move them to Schedule 3, which is a much less degree of a narcotic and probably frees up the banking system. I think short term they're going to flourish and then they're going to be like energy drinks. There's going to be so many companies doing them, they won't be the same excitement as Celsius was and Monster were in the early days. But they moved on Friday, and then you notice here 1 day change. Almost nothing was working. Defense, renewables, MLPs, they pay a dividend, and biotech. Boy, do I love biotech right now, or I have been loving biotech if you've watched my videos. If you want to look at 5 days, 1 week, a month, or a couple of months, you could look at different time frames. This is extremely useful during the day. I sneak it in at work because it gives me a lot of info. The data is real time. It updates on a cadence, but we don't update it with streaming because it's not my style of trading, and I can only afford. If I was to go streaming of everything in this product, I'd have to up the data cost a lot. And if you want to update it, you just click that and it'll update in a 3 to 5 count during the day. it's not going to shouldn't update now because the market's closed. So that is to me a very powerful tool that sits on my computer intraday. At night, just tells me how the market went. I don't even look at the market some days. Believe it or not, I got those trades, that performance trading no more than 2 days a week. Entering trades no more than 2 days a week. My stops will take me out all the time, and I'll pull up my phone and adjust some of my trades if I need to during the week. But I don't have time to trade during the day. And typically, I'll review things at night. If there's something I really want, I'll put something in Thinkorswim as a conditional order. If it gets filled, it gets filled. If not, there's plenty of stocks tomorrow. The timing brief. I love this thing and equally love the meta stock. Why? Because, yeah, I know how it works. I broke above this day and it's blue, so that's a new buy. Who wants to do that? I want to just look down here and I want to see the current signal. So right now, the weekly of the four market ETFs, the spiders, the Qs, the Russell, and the diamonds are bullish and long. So that means the longer term trend of the market, which is what I'm trading, says it's okay to be long. We had a bad day on Friday. Okay. If you look at this run up, we had a couple bad days there, a really bad day there, a pullback there. Oh, the market's dying here. And we're at all-time highs. We're at all-time highs on the spiders, the diamonds, and the Russell this past week during the week and closed at all-time highs on several of them on Thursday. Obviously, Friday we reversed. How bearish can we be one day after all-time highs? Really? The trend of the market right now is still long until I have more evidence. I'll look at the daily for fine tuning. Now, when I start to see the daily on the Qs went to red, and this will go during the day, but it doesn't count until the market closes. You can see the bongos have flipped on the spider as well. I'm looking at support and resistance, and we'll look at that in a second on the next layout. But now I'm getting a little bit more nervous, which means raise some cash. That's all it means to me. Why would I buy contra ETFs that go up when the market goes down when I'm not a short-term trader? I can't manage them during the day, and my long-term trend is still going higher. And oh, by the way, this looks horrible here. Oh man, I got killed. Really? No, it's the weekly. You look at who didn't want to be in this market until Thursday close. Well, this is going to be the same thing, in my opinion, most likely. Do I think we're going to have a bear market? We always get bear markets. Do I think we're going to have a recession? Yeah, I bet we have a recession in 26. But right now, my long-term trends are up. If I want to look at monthly, really long-term trends, I mean, this was painful right here. That's what set up the April lows. Love that. Painful, painful, painful. Had you slept right through it, was it Rumpelstiltskin, whatever the guy's name in the fables, you'd be pretty happy right now. So I am not a perma bull, but I let the trend and not the daily trend determine my thoughts. Right now, I still bullish this market. That could change. When the spider breaks down, I'm going to raise a lot more cash. If the other two break down, I'm raising more cash. Why? Because I think it's a short-term pullback. And when it reverses, I want to buy, 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 buy. How do I know the difference between a pullback and an uptrend and the market's rolling over? Well, the last thing I want to tell you is, well, when the weekly turns to a sell, it's time for me to get out. No, I'm not waiting for that. I'm looking at other tools, which we'll get to in a few minutes, the breadth indicators, all built into the product. The Guppy charts, I get excited and then I get less excited. To me, the purpose of the Guppy charts is, why are they showing monthly? Let's go here daily. Is I don't want to be in the markets when the weeklies start diving into the moving averages. And we can talk about it another time. This tells me we're still relatively healthy. This was that February, March pullback. This told me that there was more problems. We're not anywhere close to that right now, but I'll be watching. I have a US index ETF tab. I have the exact same tab or same layout in Metastock. You can create, there's nothing magic here. In fact, you could create this in TradingView because I'll give you my indicators if you buy my app. But there's a neat little piece here that not every product's going to have. So this is the run up of the S&P. And I like drawing trend lines here and so when it breaks out, I want to buy. Okay, well, the trend line's done. So I'm probably going to kill that because it doesn't matter anymore. This was the uptrend. This is that pullback that I pointed to a little while ago and said, this was horrible, right? But then you look at where we are. I thought this was so cool. I was looking at it and I said, maybe I should put a 100-day moving average on. And yep, this will be posted. And we hit the 100-day moving average on the major ETFs and bounced. So I've left the 100-day on the spider. This is one of my secret weapons. We are applying here in green 10-year and in whatever color, yellowish white, 5-year seasonality predictions. Does seasonality work all the time? No, I already said before, technical analysis trumps seasonality. But what I talked about on Thursday was we're going to pull back a few days. We're going to bottom around the 18th or 19th, and then we're going to run up in the Santa Claus rally. I also showed you why we were going to pull back on Friday, was my guess. I think the algos look at that 13-week new high, new low. It's the only explanation why the market pulls back every time that indicator gets extended and it jumps up high every time it's extended to the downside. So do I expect a little bit of a pullback over the next several days? Sure. We might not get it, but I think it's possible. All right. So this tells me short term a little weakness. So raise a little cash. I certainly wouldn't buy the farm going short. We're in an uptrend still. I like looking at different indicators. The 21 EMA here in this off-white, bluish color is what they talk about in IBD Live. All right, interesting. We pulled right into the 21-day EMA and bounced on Friday. Okay. The green is the 17. Yeah, it looks very different here, but really, the 17-day simple and the 21-day EMA are almost superimposable. And what's really crazy is if I put the 30-period WMA, it looks like those two. So turns out those three things, the 17-day simple, the 21-day EMA, and the 30-period WMA are almost exactly the same. So different people use different things or using the same thing. I like support and resistance, and I like moving averages, and they are often my targets. So I did last night on the video. I looked at all of these. I'm not going to do it right now. And we're in a pullback and an uptrend across the board. The only one that looked worse to me because it broke through the 50, and I will pop that one open up, is the Qs. So it closed pretty much on the 50, but I think it may have, this one's the most dangerous one right now. It's flipped to a short-term sell. If it breaks down below the 50, does it run to the 100? There's a little bit of pain there. Or is the AI trade getting so overdone? We're going to rally. I'll wait and see what those futures are. All right, so of course, Praveen just taught me something, and and I'm not going to figure it out now, but there's shortcuts for what I'm doing. So I looked at it. I talked about the indexes last night. I commented if the market's going to roll over, then why is the VIX still down here? And why, it was up 6.47%, but on the week, the VIX was only up 2%. I don't know. Maybe the market's going to roll over here. I'm looking for the weight of the evidence. I don't have it to tell me to get bearish yet. And then the dollar, I always laugh because here it looks like it's in an uptrend. Obviously, it broke through the channel and is traded back down. But then I always just show you how far off the highs it is. I like looking at 100 bars in these. So if you just type in 100 there, you get 100 in the window. All right, so I'll look at that on the indexes. Again, 100% the same layout in Metastock. Then I'm going to look at the commodities. I've been pretty good at calling gold this year, and I'm not a gold bug, but we had two opportunities in gold. We've had a lot more than two, but I called this one here, and I said, "Oh my God, we just broke out of a one, two, three, maybe a four-time top, and I'm buying going long gold here." Go back on the video on September 2nd. And I talked about gold and it went their breakout here. Gold actually reversed, um, but I think Friday was just an everything down day. I'd be shocked if gold doesn't go higher from here. Silver has actually led gold. And let me go back here. I always go back to my 100. And silver had a reversal day on Friday. I'm not sure why. Silver was leading gold. Silver has industrial applications, gold doesn't. Maybe it's because the market sold off and there are a lot of fears. But silver has been great. Oil's crap, about to break through the bottom of this line. Natural gas, which made me money on one of the natural gas stocks, has died. We'll see if this is a reversal here. It's got a doji, a gap up on Monday would be a morning star, but we'll see. 10-year bounced on Friday. On a lot of these bad market days, the 10-year goes down um, because people are going to bonds. And the Fed has announced that they're buying $40 billion of bonds a month. That's going to increase demand for bonds. So that should raise the price of bonds, which means rates should be coming down. Why did rates go up? Is there something nefarious out there that I'm missing? So I'm going to put that in the worry column. Now I'm going to show you some of the other secret weapons. Like many of these I learned from Ian. This is the buckets. So think about a stock. I thought it was treasury bills too, and then last night someone said they were buying bonds, but that would be, and I heard that on TV, so maybe everybody's confused. Stacy, who's a bond expert, who's a options expert, and comes from the industry, um, and is a really good trader and has a lot of stuff that I use on wealth charts. Is here. So take a stock. A Bollinger Band is a volatility band that expands and contracts with volatility. It has a midline, which happens to be the 20-day simple moving average. In an uptrend, stocks will go from the upper part of the band to the midline, back to the upper part, down to the midline. And in a downtrend, they'll bounce between the midline to the lower band, back to the midline, down to the lower band. Just imagine a horizontal band. Let's give 0 to the bottom of the band, and let's give 100 to the top of the band. You could break that band into 10 pieces, each band being a bucket. If each bucket has got 10 in it, then you have a bucket from 0 to 10, 11 to 20, 21 to 30. Those buckets represent the percent B, which will range between 0 and 1.0. So starting with bucket 1 and bucket 10 are those 10 decile ranges of the Bollinger Band. Up here represents stocks that are above the Bollinger Band, and down here represents stocks that are below. If two standard deviations, I was always learned was 95%, but then people say it's 90%, whatever. 90% of the time, a stock is going to be within the Bollinger Bands, which means it's going to be between bucket 1 and bucket 10. The more stocks that are green means it's a bullish looking market. When a market gets very oversold, we're going to start piling on bucket 10 or bucket 11. We'll have more and more stocks above the Bollinger Bands. When a market is going to bottom, it's because we have student body moves to the left and we have major numbers of stocks under the Bollinger Bands. Most of the time, it's going to look like this. This is neutral bullish. Why is it neutral? I have less than 20% above, less than 20 below. When it gets above 20, I pay attention. If it starts moving up every day, how do you know it's moving up every day? The gray bar represents yesterday. The color bar represents today. You highlight it, you could see um, where you are today for versus where you were a day ago, right? So I find this incredibly useful. You want to know how it makes me look smart? Let's go into the calendar. Let's go and show how Jeffrey looks smart. April 7th, 2025. Let's reset it. Do you notice anything different here? 76% of the stocks in the NYSE were below their Bollinger Band. 52% of stocks were below in the NASDAQ were below their Bollinger Band. 80% of the S&P 1500 were below their Bollinger Bands, and 66% in the Russell 2000. I'm not a genius. I just got really good tools. Thank you, Ian Woodward. If we were in a recession, it can get worse. We're not in a recession. Boy, was this an opportunity to make money. Um, it was not rocket science. It's the buckets. So you want to know the health of a market? You can look at the buckets anytime during the day to refresh it. If you change the date or during the day to refresh, you hit the circles. Ian only talked about the S&P 1500. Edge Rater, one of my favorite tools. I would run it the buckets also against other indicators because it allowed against other indexes because it allowed you the opportunity. I built it in here because they don't always work together, and it shows you what's overbought, what's oversold. Not individual stock, but it gives me a sense of the markets. All right. Anything here that tells me the market's going to roll over tomorrow? Nope. What's the next thing we look at? Market breadth. Love this. Now, message for Praveen. Please bring this up to the modern era. You got the old calendar, and you don't have any drawing tools here. I want drawing tools. I love Praveen, by the way, but sometimes he's on my webinar, so other people are telling him things. I'm going to tell him things too. I said something, and only one person responded, and I said this. Whoops, that's not what I want. I'm not good at drawing. Just to let you know that. Clear all drawings. We try that again. That is called a megaphone. That is ugly. And if we're in a megaphone, we could have a world of hurt. How do I think that's going to happen? I think we get a recession next year, and I'm watching this thing because in a megaphone, you'd expect it to come down and visit here. I hope not, but it hasn't changed my impression. So the megaphone is you've got higher highs and lower lows. The next lower low would be extremely painful. Well, let's stop thinking about what could and would happen. What do we got in the market right now? I want to be bullish. Look at all these tops we broke out of this week. Hence why I want a drawing tool, Praveen. That's an incredibly bullish looking pattern right there. All-time high in the NYSE on Thursday. Is this a horrible candle on a daily candle? No. Was volume massive on Friday? That tells me, oh my God, I got to get out of Dodge? No. Whoops. Sorry about that. I hit the wrong button. I was going over to look at my other computer and I hit that. Here's the volume from, where is it? It's going to be over here. I usually use Friday volume up 4% on the NASDAQ, down 2% on the NYSE from average. Not a high volume day. Volume is conviction. There was no conviction. That's why I wouldn't be surprised to see a bounce coming next week. But we know seasonality says might not happen for a few more days, if you believe in such things. So the NYSE, just off all-time highs. It's interesting, the NASDAQ's very different. NASDAQ pulled down and bounced off the 50. This is the composite, not the Qs. These are stocks above the 1750 and 200. They're definitely up, but I'll scrunch this thing down and pull it over to the right and see, it gets a lot worse before the market always rolls over. It gets worse. So we're not at a point that says we have to roll over. Same thing over here on the NASDAQ composite. And then I'll look at things on the bottom, just signals, new high, new lows. Well, look at the new high, new lows of late. Markets, bulls are built on more new highs than new lows. This is 52-week new highs minus new lows on the NYSE. This is on the NASDAQ. That's very bullish. This is the AD line, a little bit more confused, and the up-down volume line, probably less important to me. Down here are the secret weapons of Ian, of HGSI, and Market MRI Pro, and Sagar has captured a lot of them in his Q market breadth tool. He got them from me. I got them from Ian. I'm not going to go over them today except to show you what was going on in April at that bottom. At this period of April, we had what's called a phoenix, which is a exuberant move to the downside as the market was breaking down. We don't have a phoenix right now. As the market is pulling back, we started firing these things called bingos. And bingos are days when it feels like the baby's thrown out with the bathwater. And then at an extreme negative number, and I made my call already, but at an extreme negative number on April 8th, we had another exuberance to the downside. Alan Greenspan made a bad comment about the market, and he talked about irrational exuberance, and the market sold off. Well, this is irrational exuberance to the downside. So now I've got a big sell-off. I've got my bucket saying buy, 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 buy. I sound like Kramer. I don't want to do that. I've got the babies out with the bathwater. I've got the exuberance to the downside. And then I get a eureka. And a eureka is oh my, that's a great feeling. You say eureka when you did something awesome. Or you live in California in the city of Eureka. A eureka is exuberance to the upside. If I'm at a horrible sell-off and I get exuberance to the upside, I'm trading up. Here was a sell-off here, and I had exuberance to the upside. We traded up. And then we had what's available nowhere else, which is the reverse Hindenburg-Omen sign. It's called the defibrillator, and that fired as well. So the real day at the bottom was, it was the 7th. That was the low. That was the day I did a gutsy move and put it up. Nobody else was saying the bottom is in that day. That was the low. We did trade lower the 8th, and we reversed higher on the 9th. I was buying Palantir hand over foot, and I talked about that on the 9th on the video, I believe. There's cool stuff in this program. Why am I not as worried today? Well, there's good and there's bad. These are Hindenburg-Omen signs. These are signs of a potential market top and a correction. Well, guess what? We got the correction. It wasn't a big correction, but we got the correction. I got nothing in since November 14th. So we're out of the 30-day, we're almost out of that 30-day window where those Hindenburgs don't apply anymore. I got nothing telling me there's anything nefarious going on. You can bet that at 4:10, when the update's done on the East Coast, this is the first slide I go to look at to see if anything pops up. All right, let's continue my journey. Market breadth, new high, new low, 13-week. I gave you that code already. For those that joined since then, here's what you got to do if you don't have this. Go to new layout. Mine's called market breadth, new high, new low, 13-week. I'm going to find it right there. There is the number 320 342 635. You copy that number. You paste it here, or you type it in. I guess you got to type it in. Nope. You paste it in, you hit copy shared, and you're going to have my layout sitting on your computer. Simple. Simple. So we're doing both bills and maturities up to 3 years. They want to control rates. All right. So what do I have here? Magic weapon. I didn't invent this, but yep, backdoor QE, Stacy. I don't know anybody else besides Dan who uses it sometimes, and for whatever reason, Dan Fitzpatrick has stopped talking about it. This here is the 13-week new high, new low indicator. It is not new highs minus new lows. It's more about new highs as a percentage of new highs and new lows. When it gets above 95, it almost always reverses. The spider was not the one that was the most up, but you could see on the 11th, the spider was at 0.89. On my video Thursday, I commented about this on the major indices, and I'll show you why I thought we would pull back. Notice this. This is actually awesome. We got new highs on the AD line here. You see, we got positive divergence, I think, on the AD lines. I think this market has more to go. There's a lot to like here. Look at where we were on the 11th on this one. We are at 0.88 on the 11th. On the Russell, .91, and up here, was it more on the 10th? 7.9. So on the 10th, we were at 0.91 on the spider. I called it out then. I mentioned it again on the 11th. On the S&P 1500, we're at 0.96 on the 10th. On the Russell, we were at 0.95 on the 10th. And the NASDAQ, which is already selling off, we're nowhere close. Those numbers above 95 on the 10th had me starting to raise a little cash. Because every time that happens, the market pulls back. Let's look at April 7th. Giving you all my secrets. You won't think I'm so smart anymore. On April 7th, hold on a sec. I gotta make it bigger to make it easier. What is the 13-week new high, new low? 0 on the S&P 500. 0 on the S&P 1500. 0.01 on the NASDAQ. And 0 on the Russell. I'm no genius. I just know how to read the tea leaves. Thank you, Ian. I look at AD lines. I look at RSIs. I look for clear-cut divergence. I mean, I think those matter, but this is the go-to. Now, Mac Caruso, who spoke for us in June, great guy, he has a 5-day new high, new low indicator that he calls the FOMO indicator. not for the market, but when he looks at stocks, because often in the ebb and flow of a stock going up, when the market, especially the NASDAQ, gets high on the FOMO indicator, usually you have a day or two where the markets pull back. So I think there's something to the 13-day new high, new low. All right. All right. But what else do I look at? I mean, that's it for the market. Then I look at my sector tools. I look at the ratio charts, which I don't know how to do ratios in Metastock, doesn't mean you can't. And you could see how healthcare has been strong. Technology is getting hammered right now. Gives you insight to what's going on. Industrials have been really strong. That's interesting. Now, these are ratios. This compares the underlying in the box with the S&P 500. Bitcoin has been underperforming, no surprise. It bounced a little bit there. I could also look at the sector timing, just looking at what's got new reds and greens. Again, technology we got to fix. There's a split in there, but I can apply the timing model. You can do that on Metastock as well. But where Market MRI Pro excels is not this. All right. To me, that was all worth the price of admission. Here's where Market MRI Pro excels. So for the Metastock crowd, I've asked Praveen to take the tool that I'm going to show you right now and port it to Metastock. It will not be part of the app. It'll be, if you think about the Armo ATM, somebody, Rahul Mohunder, developed a freestanding radar screen for Metastock and he put his indicators in. I think I can do the exact same thing with this module. I just want to, Metastock is important to me. And ultimately, I want to use Metastock data as an option for driving Market MRI Pro. And that's our roadmap. And why is that? Because at some point, I want people to have a choice. You'll still have to pay something to us on an annual basis, but you might be able to use a second data source, and that protects you if something happens to our source, to myself, to Praveen. And I don't want to be that guy who leaves you with a product that doesn't work anymore if something happens. So we will port this to Metastock data at some point. In the short term, I want to port the scanner. The impulse is where I start, and you could see today there were 3,739 stocks. That means if you take the NYSE plus the Amex plus the NASDAQ, filter it for $1 and 100,000 shares, there are 3,739 stocks that meet the filter. That's the universe we're playing with today. If we have a big up day on Monday, or we go back in time, you'll see a lot more stocks. I'm not going to do it today. You can actually back test. You can pick how many days you want to go back. I think it'll be even better if we had a calendar function. And you could look at what the radar screen here or what the grid would have showed us on a given day. You want to test my double momentums? Go ahead, go back 5 days and look at the stocks and what they did. Very cool feature that I haven't shown you. So I've got that 3739. Go to the top-down view. If I look at the sum of the stocks in the sectors, it equals 3739. So every stock in our universe is in a sector. It's very important that you know that because if you look at the S&P 500 sectors, there's only 500 stocks. It's looking at sector performance on the biggest stocks in the market. If you look at the S&P 1500, it's got the S&P 500 large caps, 400 mid caps, and 600 small caps. So it's looking at the 1500 of the larger stocks in the marketplace. I'm looking at a much broader group. Right now, breadth has improved. The RSP and the QQEs are doing well. And so I like the broader breadth. Sometimes I don't want to look at my breadth, the top down. So I could have flipped to the S&P 1500 and let's see if the gods like me. Notice we just changed to a universe of 1500 stocks. All right. Or I could look at just the stocks. Now I got it. It's in the S&P 500 or just the NASDAQ 100. But I'm going to stay with my base list, which is the big list. So there's my 3,739. This will update during the day, this portion here, and your chart get updated automatically. You don't have to wait. If you want the chart to update immediately, right here. One thing that we can do, I think, Praveen, is we need to have the same global refresh. Even though that little thing is in there and it's a chart, I get it. It might be good to just have the global reset, the same one on every one. Over here, there's a reset if you don't want to wait to the next streamed update, which occurs every couple of minutes, you can do it yourself. So I'm a top-down guy, and this for the Metastock folks, this is why I want to port this tool to Metastock. I'm going to sort based upon 2-day performance, just because I don't think that Friday was necessarily indicative of where we're going. And what comes to the top is financial services, consumer cyclical, and basic materials. And then I'm going to go over here. These are now just the industry groups in those sectors. I think that's I'll let Praveen answer, but I think that's the updating all the scans when I change something. Um, like if I hit this or you talk, yeah, Praveen will answer and make sure that's right. So these are the industry groups in those three sectors. I'm going to also rank them by short-term momentum. And now what I'm going to do is I'm going to take the top 10, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We just spent time and I've convinced myself, at least at this moment, that I think the market's going higher. Am I buying without seeing the futures on Monday and the market's opening? No. I'm going to take the weight of all the evidence. But right now, I think Friday was overdone, and I think this market goes higher at least into the new year. That's my guess. Who cares what I guess? I'm going to look at my signals every day. So I'm still thinking long. All right. Over the last couple of days, these are the three best sectors. I could have gone here and picked over a longer time frame. Maybe we'll do that. I don't usually do 5 days, but maybe that's what we'll look at. So let's clear this and let's look at over the last week or 5 days momentum. And let's see what's leading. Financials, basic material, communications. Now let's go to 5 days ranking over here. And now let's take the top 10 movers. I'm a slow trader. Maybe I shouldn't be looking at 2 days for. All right, so here we said the market's probably going higher. Top 3 sectors on that time frame, top 10 industry groups in those 3 sectors, and 183 stocks in our universe in those 10 industry groups. Now, I don't like little things, so I'm going to eliminate anything that's prices less than 5 or less than 500,000 shares. I'm left with 102. Now, I could just rank them by 5-day momentum, and let's just look at some of them. BBGI. No, I'm just looking for things that I like. Innova. I want to know more about this. The market's doing horrible. What happened here? Secret weapons. Fundamentals. And not 1 quarter or 2 quarters, going all the way back to 23. And it's going to compare this quarter to the same quarter back here, 320 versus 260. That's 20% plus growth. Okay. I see that not only is it growing on earnings quarter over quarter, again, 336 versus 245, not 336 versus 323. I want to compare like quarter. I've had surprises. Markets love surprises. Earnings were out 10/23. Next earnings are February 3rd. Revenue growth, a little bit slower than earnings, but it's growing. Trades at a multiple 12.7. My goodness, we're growing earnings 30% or more. That's undervalued, perhaps. What do? I'm going to highlight it. I just touch it. I take my hand off the mouse. Technology and analytics company providing online financial services in the US. Okay. And then I now know the earnings are good. If I click on it, it stays. If I just hover, it just shows me. Come over to the news. Surges, indication of further gains. All right, so Zacks actually had a question yesterday, so I might open up Zacks. Guess what? It'll go right there. You can read about it. So I'm not sure I'd buy this after this move, but I'm interested in knowing more. And if I highlight it, I see the high jumps at 100, which tells me it's short-term extended. I probably wouldn't chase this. But something's going on there. This one actually had the double momentums. All right, Ram, are you sure that you ranked it by FM5 for sectors, FM5 for industry groups? Which guess what? I didn't do FM5. I'm just going to leave it where it's at with FM2, shorter term on the industry groups. All right, so FM5, FM2. I thought I did FM5. And that you're using the base. And if not, we can sort that out. Kabin can take a look because it should match. This is some kind of a preferred or bond, so I'm not going to look at it. MA. MA was my stock of the night, one of my two or three. Visa looks good. ENVAs and financial services. Financial services over the last week is the best performer, even though it was a little bit negative on Friday. I had a trend line breakout. That happens to be a John Person buy, but you can't have that unless you were lucky enough to show up on Black Friday and be one of the early users. But I think John's going to open it up to the public later this month. But look down here, you could see at least on Thursday I had momentum, breakout, volume, and a CPR. CPR is not on Metastock. Probably have put it on it at some time. So I like that one a lot. Visa also looks similar. Roll the dice, pick which one you want. Maybe I should have looked at fundamentals. 314 coming in against 275. That's good. 0.7% dividend. If I go up and look at MA, it'll change here. 421 coming in versus 382, so about 10% grower. Pick and choose what you like for the workup on options, which we're still going to do today. I liked MA. I looked at LN was another one, and bottom fish too far down, but maybe it's going to run. SPGI was another one I liked. So I'd rather see it close the 200. So in Market MRI Pro, that's top down. Sometimes I'll say, well, I like pullbacks and uptrends. So what am I? I'll throw that filter in. Brings me down to only 19 stocks. So I want to see the ones that had the best moves, the most impulses. So SMG, Scott's Fertilizer, not yet. Here's that Kroger's now, Kronos Worldwide. I think that's a specialty chemical. Aon, there's your MasterCard, there's your Visa. SQM is another specialty chemical fertilizer stock. And, I'm finding, considering the market, I might be finding things that look interesting here. So that's top down. Bottoms up is the fun stuff because then you get to look at only shiny objects. And so I'm going to go back to the impulse view. And let me kill all my filters, and I'm back to 37, 39 stocks. If you find that you don't have any stocks showing up when you scan, make sure you took out your filters. I make that mistake all the time. And here is the other piece that I love. I've got signals, I've got patterns, I got signals, I've got moving average support and resistance. I got all kinds of stuff in here. But what I got are my A pluses and my A's. There was hardly anything in the A pluses last night. That whatever this thing is, and then Ascend, which is a biotech. They've got a product on the market. They're starting to build up their revenue and earnings. You can see they're turning earnings positive allegedly in February. I think multiples are meaningless because eventually they're going to have infinity growth rates compared to the negatives. Um, Expensive stock. Um, on a horrible day in the market, this thing was up, so you might want to look at news. Um, Pricing power and idiosyncratic growth. Huh. Okay, maybe that's a good thing. Um, you read about them. Decide if you want if it's something good or not. But that was made it. What? How do you get in this scan? Double momentums. Relative strength better than the market. Volume breaking out. The A is my pullbacks and uptrends with a breakout or momentum. A little bit easier to get in here. There's a lot of overlap. ACB is a cannabis stock. Massive volume, gap volume, breakup momentum out of a squeeze. Okay, not my stuff. But here's Ascend again. And why is it here? Because it's coming out of a squeeze. It's got either momentum or breakout. It has both. Relative strength versus the spider above the moving average. Volume breaking out. That's the requirements. Catalyst is another specialty pharma, I think. Sort of a cup handle. Is a breakout coming? CBE is an energy play, which I thought was weird considering how weak energy or oil was. Earnings are out. I remember when that happened, it pays a 3.85% dividend. Amicus is another biotech stock. I mean, that's pretty darn tight. Galt is another biotech stock. Is it going sideways, ready to break out? Then you have McDonald's, and then this TTSH. So when I looked at all of these from my top down choices, my bottoms up, what I came up with as the stock I wanted to trade was Mastercard. I am in healthcare. And the reason why you got to be careful with biotech is you have 4 quarterly earnings. You know those are telegraphed. You have FDA approvals and denials. You have no idea when those are going to occur unless you know about them and are paying a lot of attention. You have data being released at healthcare conferences throughout the year that move the markets. How do you know that's going to happen? They're tough to trade. There can be amazing winners. I just buy this guy. Now, I'm still long LABU. I've been long LABU since my buy the market day on April 7th, and it's done okay for me. At some point, I'm going to get out of LABU. Typically, it pops and then it sells off after the JP Morgan conference the second week of January because a lot of M&A occurs going into it. What's the advantage of LABU? You got a basket. A single drug blows up, it probably doesn't hurt as much. What if the stock that you don't own gets bought out? It raises all of biotech. It takes the basket up. So I like LABU. Now let me talk about Metastock for a minute, and I'm going to go into slides for speed. So I've showed you all this in the deck. There's your shared ID for market breadth analysis 2. There's your share ideas coming for something else for the timing model applied to stocks. For those that don't understand my charts, because there's a lot of crap on them, my whole intent was to create an EKG for stocks, and that's what these dots are all about. Here is an explanation of the colors of the moving averages and what they are, what each thing is. It's easier to see there without that, what the different indicators are. And you can see they're numbered in Metastock 1, 2, 3, which makes it really easy to see. This is the relative strength versus the spider with the moving average, daily and weekly in my Metastock charts, and then my OBV with an average. Here is the pattern in, well, it's both wealth charts and market MRI Pro, but it's the same order of indicators. Okay. And then my best supporting actors really are this relative strength of the underlying versus the spider compared to the moving average. All my thanks on that go out to Chris Wilson, a fellow HGSIer who sat in Ian's meetings. One day he elbowed me and said, "Look at this. If you look at the weekly chart, the weekly relative strength versus the spider, and you put on the moving average, when it breaks out, the stock begins its long move." And I'm no idiot. I'm willing to learn from anybody. And it's a great indicator. It shows you you're outperforming the market. I use it both on the weekly and the daily. I like OBV. John's got better volume, but I'm not going to talk about it because you can't get it yet unless you have it in TradeStation or another platform. And I look at divergences, support, and resistance. This tells you about the dots, the gaps, the volume, the breakout, the momentum, the high-low oscillator. When it's above 95, you're extended to the upside. When it's below minus 95, you're getting extended to the downside. Let's talk about one of the superstar strengths of Metastack. These are called explorations. I run them every night. I've got long-term downtrends and uptrends. I got momentum, which is a double momentum. I've got pullbacks and uptrends and retracements and downtrends. I've got short-term downtrends and uptrends. And then I jump into Sager stuff. So I run those chart, same chart, basically, except it has the weekly relative strength versus the spider. Exact same tools. And let me just show you some of the things that I get out of this. The dual momentum, when you look at up downs and it's positive, the bullish is my double momentum signal, the exact same signal that we see in Metastock, in Market MRI Pro. You can scan a lot of stocks, and I do it end of day. You could also do it during the day. So it has automatically defined trend lines, which I like. And this was, I got to put my glasses on because it's too small for me to see. This one was Aon, which was actually one of the ones that I went through real quickly when I was looking at Market MRI Pro. It's got a dual momentum bearish. Again, you look at up, down, you want it at -1. It tells you whether it's in a squeeze or not. Is your volume below or above the moving average? If you're going short, you want it below. And is your relative strength versus the market stronger or weaker? So this stock here is Acadia Realty Trust. Now this one failed also at a long-term trend line. And down here, it's got the double momentum. How about, this is, well, this is dual momentum breakdown as well. And this is ARM Holdings. And you see it breaking down below the 200, relative strength breaking down on the daily and the weekly, as is volume. Pullbacks in an uptrend. Here's a scan. These are the stocks. I rank them by dots. Again, OBV1 means it's above. 0 is below. I chose MasterCard. Look at MasterCard. Here's an auto-generated trend line breakout. It also broke above the 200. Relative strength on the daily is breaking out, as is OBV, and we're almost there on weekly. All right. Retracements and downtrends. So these are stocks in a downtrend. It pulled into a moving average and broke down. All right. This one here is Suzano, whatever that is. It had 4 down dots. It had OBV was still positive, which wasn't great. Wait a second. Is this the right one? Well, it looks to me like the OBV is just breaking down today. Relative strength is just breaking down today. So then I have long-term downtrend breakouts. So it's looking at the trend line and it broke out above. This was Ingersoll Rand. I got long-term bounces. It traded in and didn't break out. It fell down. This is VeriSign. Long-term uptrend, pull into it and bounce. Long pullback on uptrends and breaking out. That's my kind of stock. Interestingly, this is RTX, which had a double momentum 2 days ago. All right. Long-term uptrend, and it broke down. Bearish stag. Long-term down, short-term downtrend, and a bounce. If I'm looking for stocks to short, this was Cantor Brands. Short-term downtrend and a breakout here, and that's Global Life Insurance. So short-term uptrend, here's the uptrend, and a pullback and a bounce. It would have shown up on this day. I don't know how many days they keep it for. Short term, and then the bounce, short term here, and it broke down. So I think those are really good scans. The fact that they incorporate the trend lines gives me something I can't do in Market MRI Pro today. Are they complementary? Maybe. Obviously, there's pros and cons, and you can see Market MRI Pro's got the breadth tools. I think they're complementary. So I'm all about my A-trade pullback and an uptrend. I've got the tools to find them. I've got a trading plan, and I want to find the next market leader before it's too late. And I want to wash, rinse, repeat in success. This is an uptrend. This is a pullback. I want the stock when it starts to move higher. I don't want to buy it here. I want to buy it after the turn. I look for the weekly green. The daily's gone from red to green. I want it to be near support or moving average. I look for my momentum signals, and I look for my supporting cast. Bottom fishing, stocks in a long-term downtrend. Mastercard, not quite as extreme, but it breaks out, pulls back, and then it starts to run. I want to buy it here. How do I find them? Again, you can read this at your leisure, built in. And then another thing I'll trade is when something's in a well-defined Darvis box going sideways, I'll sell and buy. And then there's matching shorting setups, which we can talk about. We're going to go into the option stuff that people like in a second. I found that trading the top-down approach over the long term has been best for me. My timing model is designed to capture most of a big move, but more importantly, keeps me out of major market downturns. It's objective and does not repaint, so you can scroll backwards to review. And the weekly guides my direction, the daily guides my level of commitment. My explorations help me identify my favorite setups. Once I identify a list of charts, I review them. I look at setups, support, resistance. The indicators and scans help me find actionable stocks, but the chart guides my decision making, and I don't trade against the major trend. Those that know me, some of you are new to me. Some of you are probably asleep because I talk forever. Um, I don't, I don't really even know how to deal with the fact I'm making money selling product because this has been my hobby and my sport and not my business. My business, like I said, is building and flipping healthcare companies, but I want to support you. And so if you have my tools or you don't, join the top down group, the videos, the support training, my commentaries. I'm going to have defined dates for quarterly training for the owners, but I'll invite everybody most likely. Live seminar, the Orange County is the cheap one in June if we do it, $300 to $400. I do about 40% of the speaking. The Palm Beach County one will be late October, early November. Not as cheap, probably $1,200 to $1,300, but the difference is you get me the whole time, good or bad, that's up to you. But I feed you and water you every meal that we're together. Any questions, marketmripro@gmail.com. So should I continue or take a short break? All right. The answer came up before I said something. I am going to, it's exactly 1 o'clock. Let's start at 1:10. So I'm going to pause the recordings and we'll start in 10 minutes and we'll spend 20 to 30 minutes looking at how I trade options. Thank you. And on that one, and then on this one, restart, resume. All right. So we're going to talk about options now. And, first, let me just reiterate what I said before. Options are considered dangerous. Options are, you shouldn't trade them without knowing what options are. Um, the Options Industry Council has a wealth of information for you to help you learn rather than invest in losing trades. I went through a number of options education. God, I even did optionetics. It was so long ago. Um, but what I really learned is from the School of Hard Knocks. I look at options like building a house, and I'm talking about just the exterior. Options are bricks. I got bricks called calls, and calls, you when you own a call, it's because you think the cost of the underlying or price is going to go higher. There are puts. When you own a put, it's because you think the cost of the underlying is going to go lower. But like a house, you can build apartments, houses, outhouses. You can build all kinds of different things to accomplish different goals. If you buy an option, you get the right, but not the obligation, to buy if it's a call or sell if it's a put at the agreed to price. If you sell the option, you have the obligation. If you sold the call at a specific strike price, you have the obligation to deliver that stock at that price. Or if you sold a put at a certain strike price, you have the obligation to buy the stock at that strike price. Now, there's a lot of other things that happen. You may have the right or the obligation, but no one says you ever have to exercise. You can sell your option back. And there's always somebody to buy that option back. If it's a low volume option, and Sam knows I have a tendency from the podium to find a shiny object to do a trade on, and I end up with really low volume options that it's hard to get rid of them at a fair price, which is the problem. So I want to take those four things: buying a call, selling a call, buying a put, and selling a put, and I want to create structures that meet my trading goals. I am not about creating income. Got plenty of that. I will at sometimes be about protecting my portfolio, but that's not this conversation. That could be a different conversation. I'm about growth. So I want to come up with options to be substitute for stock that will allow me to get in cheaper than buying the stock, have less risk than buying the stock, and have potentially a big or unlimited upside. I am very different than a broad-based traditional options educator who's going to spend a lot of time on condors and things that straddles, strangles, things that I never do, at least intentionally do. Sometimes if you look at all my trades on a single stock, they take on names of things I didn't even know how to construct. But that just happens. But I'm about directional option plays that are low cost, define risk, which could be lower than the stock, with high upside. I have listed the only trades that I typically take besides buying the stock. A long call, a long bullish call spread, no unlimited upside, but cheap. A broken wing butterfly, so much better than a regular butterfly. Ratio back spreads, sometimes it's one of the best trades because if the market drops, you might make money on it even though you made a long trade. Synthetic stock, the danger Will Robinson trade, but boy, can you make money on that trade if you're right. A synthetic call, aka the chicken shit synthetic stock, um, probably one of my most common trades. And then one that doesn't get enough credit, the married put. I can live in a world where those are the only trades that I can take, plus owning the stock. So let's talk about it. Now, last night, I decided, and I've changed my mind, that I was going to talk about Royal Caribbean lines. And, and so you're going to get my PowerPoint. So you're going to get my workup on RCL, but I want to do MA. So why did I like RCL? Well, look at it on the chart. You had a recent, not on Friday, but on Wednesday and Thursday, you had double momentums coming out of a squeeze. The relative strength, good. OBV, not so good, not extended. I love the idea we broke out above the 50 and the 200, and we really didn't give much back on Friday. Seasonality is kind of neutral, and these were the ones that I had identified, and I thought I was going to do Royal Caribbean. So I'm not, but you'll be able to look at all the things that we're going to do on the next stock. They're all here, current pricing, and this is a sheet you haven't seen before that we're going to end up with. So we're going to do MasterCard. Pull back in an uptrend with a fresh breakout, relative strength, and the volume confirming, not extended. It has a daily PPS buy on Thursday, John Person's like one of the best indicators, and it's got a weekly PPS buy. So also showed up on my pullbacks and uptrend scan in Meta stock. All right. So let's talk a little bit about money management. And to do it justice, let's go into Metastock and let's look at MasterCard. Now, one of the things that drives me cuckoo with Metastock is figuring out their symbols. All right, MAN. That looks like MasterCard. All right, so let's just review it here. We have the stock that was in a downtrend, okay, on the long term. On the short term, it just had a recent pullback again after coming up, but it's just reversed. The weekly bond goes green, telling me that's switching potentially to a new uptrend. And the daily bond goes green. I like that. It broke above the 200 and this automatic generated trend line and the 50 in the last two bars. The relative strength versus the spider has broken out, so it's stronger than the market. The weekly is ready. It hasn't crossed yet. That's okay. It always crosses a little bit after the daily. And the volume cross positive. And the high jumps at 41. I don't see anything here that says I can't take this trade. So that's my justification. Now, the current price, well, let me get something to write with because I forget what I'm saying, but the numbers matter here. So let me a piece of scrap. All right. So the price of MasterCard right now is 571.93. The way that my trading works is I like to buy high to go higher. Now, a good friend of mine, Kathy, would say she'll set the price. Oh, I like Jeff's pick, but I'm going to set the price down here and wait for it to pull back and get filled at a lower price. That is something that is not wrong, just different. I'm going to say that's not me. I'm going to say the high of the day was 573.61. And let me see if I can get that right. The close was 571.93. So I might actually put my buy stop at 573.75. Why would I do that? If I have conviction here, why would I set my stop above my buy stop above the high of the day? Simple. I set my trade on Sunday night. I go to work on Monday. I got a busy week. I haven't been in the office in a month. I don't want to get filled if the market sells off. So why would I set the price below? Let it continue up into my price for me to get filled. Simple thought. All right. Now, if the maximum I'm willing to risk on a trade is 8%, and I'm buying it, this is expensive stock, but that's okay. Most turns out you make a lot more money, I think, on expensive than cheapies. 573.75. So if I buy it at 573.75 times 0.08 equals, I'm willing to give it $45. So that gets it down to 528. So that's all the way down here. I don't want to go that far. I'm looking at this chart. My first stop I look at is the lowest bar in the last 4 bars. So that one, the low is 535.97. Well, that keeps me within the 8%, but it's way too wide. I'm buying this for a number of reasons, including the fact it broke out on this trend line and it broke above the 50. I also like that it broke above the 200. So why not set my trend line right below the 50? So that would be 550. Say I would put it at five. What is it at? Somewhere around 555. So let's say I put it at 554. At 554, I'm only risking 19%, 19 bucks per share. It's big, but $19 on a 573.75. Make sure that the math works. 54, yep. $19, that's less than 4%. So my stop is going to be 554. So that's a 4% move. I want to at least make, because this market's still questionable, at least 1-to-1. So I would look at that 573, say 574, add 19 bucks. I'd probably put my first target up here at around 593. And what I would do is I would take off some at 593 and then bring my stop up to break even. Again, this is how I think and how I'm looking at the trade. Now, if I was willing to risk $10,000 on this trade, and I was going to risk $19 per share, I can buy 526 shares. How many calls do I have to buy to get 500 shares? 5, right? Okay. So if I was to buy stock here, based upon what I'm willing to risk, I would buy 526 shares. If I'm just going to buy an option, I might look at as little as 5 calls. I probably will go bigger than that, but I have to keep in my mind that if I play by the rules of what I'm willing to risk, I could only buy 5 contracts. But that 526 shares was set because I'm willing to risk 10,000. So I'm going to look at both what's 5 contracts and what's a $10,000 risk. What does that buy me? So I, when I put my orders in with Thinkorswim, I'm going to tell that if the stock trades above 573.75, then trigger the following trade. And when the trade triggers, it's going to say if the stock trades below X, and I think what did we say it was going to be? 554, then I'm going to close out the trade. So I can put all that into Thinkorswim. Now I got to define what trade I'm going to take. So let's take a look. Close this down. So I ran the spread tool inside of, it's called dynamic options, dynamic trend, dynamic trader, whatever. It's within VectorVest. They have a deal with Tom Joseph, who did a advanced get, which eSignal bought. And he's got he sells the options tool. He sells it separately, or you can get it. I get a little bit better deal because of VectorVest. And what I did in the options tool is I put in MA and I said, I picked January 16th, which is kind of short. I probably should have put February, but all the stuff I created after this point are January, so I'm going to leave it alone. I went in and said, let's select spread types. Long stock, long call, forget the short put. Bull call spread, yes. Bull put spread, no. Synthetics, call ratio back spreads. And then I want to put in a married put, and then I want to put in a butterfly. And then I went in here, starting price is 570, cool. I want a minimum on, let's say, let me go back, let me just look here. I put a minimum of 20. So I want to get up to that 593 area, which is my first target. So I want at least 20 move. And I'm going to update. And so these were the basic trades that I could look at. It tells you their current pricing, bid and the ask. And I noticed that these were very far apart. But I got to believe that MasterCard is not a illiquid option. So maybe it's the weekend. Who knows? So I would take it. I'm doing this, but I have to go spend more time looking at open interest and make sure there's enough liquidity. So when I see that big bid-ask spread, I'm not a happy camper. So I'm just putting it out there, but this is education. Whether I take the trade or not is irrelevant. These are some of the trades I look at, and then I want to introduce you to hold on a second. This is a P&L curve. And what this is looking at, here is the current price, 571.87. If the stock price goes up, you see more and more green. And this is my P&L line. I make more money. If the stock goes down, I lose money. I have unlimited upside, and all I can lose is $571.93 per share. One contract is 100 shares, so that's 57,193. This is what the stock curve does. Now, none of us here are going to buy a stock for $571 and ignore the stock and not care where the price is. We're going to put a stop on it. So we're going to manage this stock where we're willing to lose whatever. In my case, it was $19 a share, and in exchange for having a big upside. There's nothing wrong with buying the stock. 500 shares, though, is going to be $260,000, $280,000 of capital. Most of us don't want to tie up $280,000 of capital in 500 shares of a stock. So to me, it's a perfect one to look at an option. But I want you to burn this graph into your head. All right. The other thing that I want you to see is that this blue line crosses the yellow dotted line or white dotted line, which is the current price. So any movement above the current price is profitable, and any movement below the current price, you lose money. So now let us look at alternatives. Let's see if we can do it with the slides. So here's buying the stock. Here is your cost for 100 shares. It's $57,193. Again, 5 times that for 500 shares. Again, pointing out that the break-even line in the current price is the same. That will be different with options. It's one of the downsides of certain trades. How about we buy a call? And the beauty of this call is many. One of the beauties is that's kind of what you want to do with the stock. You want to leave the stock so the stock is going unlimited upside. You're capping your downside here. Now there's a very big difference though between buying a long call and buying the stock because you have the factor of time. Because that purchase for $1,467, which is considerably less than the $57,000 it would have cost for the the um, the one option, the 100 shares of stock. Um, this has a time limit, so you get in cheap, but you could be right. It could go higher. The market might sell off for the next month, and Mastercard drops 3%, and then the day after you expire it, it runs up 100 points. You get nothing. You have to deal with the landing on the time. Something else that's going to occur here. Here is today's price. You've actually got to move to break even. You got to cover a $14.67, 68 cents move to break even. So the benefit of the long call is instead of spending 50 some $1,000 to control 100 shares, you're controlling it for $1,467. The most you can lose is $1,467. Your upside remains unlimited with the caveat that you got to move to break even. So cheap trade, I think the likelihood of success is a lot lower than buying the stock because the stock, if the price doesn't change, you didn't lose any money. You got to cover that $14.67. Why do people take this trade? Because it's cheap. It's simple to figure out. You know what your risk is. And if I was willing to lose $10,000, I could probably do 100 plus contracts. I can control a zillion shares for that $10,000. Still not my favorite trade. Absolutely nothing wrong with this trade. Absolutely nothing. The longer the time and calendar, the more expensive the trade is. The fact that we're at the money here makes it more expensive than buying something that's out of the money, in which case you have to move even more perhaps to be profitable. I like buying deep in the money or at the money because I don't like paying all time value. Nothing wrong with a long call. What about a vertical spread? So that long call that was going to cost you, um, was it $1,700? I can't remember. 1467. Now this trade only cost you the price of the long call minus the short call, or $8.63 a share, or to control 100 shares, 863. So now a couple things happen. Your risk is lower. All you can lose is the $863 that you paid for the contract. You don't have to move $17 or 1473. All you got to do is move $8.63 to turn profitable. So that makes it easier, but you're capping your gains. So what you've done is you've given up unlimited gains, you reduced your downside risk, and you did it in a much lower cost option. You did it for 862, not 1467, 1468. Yeah, somebody asked about what do I do with high volatility. Well, this is one trade that might be useful, where you're buying delta and you're selling delta. So you are mitigating some of the high cost of that volatility in the long instrument by selling something against it. Um, I will do this trade rarely because I hate the cap, but no one says that if the market starts to move that I can't buy the short call back, but I'm going to have to pay for it. So that's a long call spread, easier to get profitable, less downside risk, cheaper to get in, but you cap your upside. So it's not my favorite. Butterfly. It looks pretty and it's really, really cheap. For $480, you can control 100 shares, and your maximum gain is 20 bucks per share. But to get that 20 bucks per share, or excuse me, yeah, is 20 bucks per share. So on the one call, it's 200. Your maximum risk is 480. Your max profit is you can get to 2,000, and 2,000 minus 480 is 1,520. That's a pretty good return. It's better than 3 to 1. You spend 480 to control 100 shares, and you can make back 1,520 after cost. Why do I hate this trade? Do you know how hard it is for you to finish in the money? This is the jumping out of a plane with a parachute, and you got a 3-foot X on the ground. It's your first time doing it, and you're supposed to hit the X. It ain't happening. You have to fall between your long call that you entered with and the 2 short calls that you sold against it. And then you buy another long call to protect your downside. And that gives you this TP. And the only way you make money is if you have to move to cover, you got to cover $4.80. Here you're buying an in the money call, so you're already in the money. But it's in between this point and this point are the only places you make money. And you don't make anything like this unless you hit it exactly, which, trust me, isn't going to happen. I don't like this trade. It's cheap, very limited risk, 3 to 1 return, but boy, the odds of me landing at a good level are so narrow. But I can make this better. And I talk about 2 types of what I call better butterflies. Just in my opinion, they're better butterflies. Now let me go back here so I can find it and actually see them, because it's going to take a second for me to find it. I got a lot of stuff in here that I did today. Okay, see if that's the right one. Bam, that's Royal Caribbean, not the one I want. Try another one. Let's see if I can see it. It's hard for me to see it, and then I got to reconstruct it. Well, let me just talk through it. What I could do instead of let's go into the constructing tool. I'm going to do it here. I just don't remember exactly what I did. So in a long butterfly that gave us this pattern, I bought one call at 550. That's still in the money. I sold two calls at 570, which is sort of at the money. And then I bought a call at 590 to protect me. So think about that. Here is today's price. It can drop all the way to here, and I can still make money. Or it can trade to here, and I can make money. So if it's between 554 and 585, so there's a 31-point area, I can make money. But if I look at the real money, when I'm making $1,000 or more on the trade, it's got to be between 565 and 575. If I want to look at the real money up at the top, the max, the window's between 570 and 570, not happening. So the trouble is to get a significant return, I get narrower and narrower. So what I could do here is one of the things that I'll do, and I call this the wide butterfly, I'm going to move this 590 out to 610. And I'm going to move the middle one to 580. Let's see if that's right. 30 and 30, hit OK. So now I've got profitability between 560 and 600. So I've increased my profitability, but I've had to spend 1,035. I don't like butterflies. No matter how I construct a regular butterfly, I'm going to have a narrow range where I win. Almost impossible to win big. And if I'm right on the stock, I'm right on the direction, and my two short calls are here, and it keeps going up in value, I'm going to have maximum long. I do not like this trade. But let me show you how I can make this trade work for me. Open it up again, long butterfly, and this is a broken wing butterfly. What I want to do is I'll leave this here for the thrill seekers, but I want to have I make money if it blows through the top of my trade. So I'm going to now look at this, and I'm going to edit the spread. I'm going to move this to 610, and I'm going to move this not to 580, but to 590. Let's see what it looks like. That looks different, doesn't it? It means that I still have this crazy piece here where I'm never going to hit it. My risk is the cost of the trade, which is going to be $17.95 per share. But my tail here means I make profit even if the price goes through all the calls, right? This number is not going away, at least this. Is that a great trade if it goes here? No. But how about the stock price trades all the way over here and I did a regular butterfly? I lost money. So here, if I'm right on the direction, I'm right on the name, but wrong on the strikes, I don't lose money. I make a little money. So that's a broken wing. Now, I don't like that shape. So I might come in here and let me play around with this a little bit. I don't need to be so far. I'm going to move this up to closer to the current strike price. I'm going to move it to 570. And I'm going to move this one to 600. Now let's take a look at it. I like this one a lot better. Do I look at expected? I always look at expected move. What is the option money? The market makers think that's going to move over a period of time, and that will help me on strike prices. And I will tweak all these as I'm showing you here on the call prices. So now I manipulated it. Now it's going to cost me $10 to get in, not 17. My maximum profits is 2,000 up here, but I'm still making 1,000 here. So I actually have a trade where I'm paying 10, I can make 20, but if I go too far, I'm still making 10. I don't mind this trade. This is my typical trade. I may play around with these numbers to make it even more attractive to me. And if you look in here, I want to show you, I have to move that much to start making money. I don't have to worry as much about hitting this because if I blow through it, I still have a profit on the trade. And as long as the stock goes through it, I don't have the loss on this side. So this is a broken wing butterfly. That is one of the more common ways I enter a trade. How is this even better? You can have volatility where the volatility curve looks like this. Here's at the money, and volatility actually goes up as I go away from price. I call that a smile. This is great for a broken wing butterfly. Why? Because you're selling two calls that are at a much higher volatility than the one you're buying. So I especially like broken wing butterflies when I have a smile. I can actually scan for smiles. On the other hand, if I have a frown, and the same thing, here's at the money. The volatility is more expensive here, and it's much less expensive here. That is probably going to be a different option strategy because I'm not going to get enough on my short two calls to make this trade work for me. So I will scan for this trade all the time. I'll scan for smiles. All right. I always feel weird because Stacy knows so much more about this than me, but I only know about the trades I take. So I like entering. Now let's just talk about trade management. Let's say I buy this trade and in 2 weeks, the market is now at 590. And it's like crapola. I should have done an unlimited upside, or I should have given myself more space. I got 2 more weeks of time. We're almost at the strike price. Here would be when I stop, my profits start coming down. Actually, here is where my profits start coming down. Here is where they start going sideways. I can do a trade. I might say, let's do a new butterfly. Let's buy 2,600 to make those go away. So we go positive 2 at 600. Maybe I'll sell 4 at 630 and buy 2 at 640. So what happens is when I do that, I'm going to have plus 1 at 570. I'm going to have plus 1 at 610. These are going to wipe out that. Then I'm going to have -4 at 6:30 and 2 plus at 6:40. So if I do the math, I have potential for -20K here. The 570 to 630 is plus 60K if it runs all the way to 630. The 610 to 630 is going to be, so 1 here at, okay, let me just go through the math again. So -20K, 570 to 630 is plus 60K, right? Plus 570, so that's plus 60. All right, so plus 60K here. 610 to 630 is plus 20, but I got 2 of those. No, I only got one 610 rather. So this is plus 20K. And then I'm -4 there, but 2 of these are canceling out these. The other 2 cancels out this. So this trade now has plus 80 in it, -20 if I go through 640. So what I did is I increased my upside. This is not going to be an expensive trade because these guys, 2 to 1, cross that out. And I will step these up and out. Now, sometimes I may look at and say, no, I want to be in February. So I may look to create these in February, not necessarily in January. So what happens is I leave these negative calls there, but I've got new calls for the next one that are long. So there's all kinds of ways that I can manage this. And I made 6 figures on a number of stocks this year. And I did that by doing one broken wing after another and never owning the stock. So always know what you're risking. Always know how much it has to move for you to be in the money. And I think broken wing butterflies are very interesting. During earnings season, I will do some stacked broken wings. I may do a +1, -2, +1 above in case the stock goes up. If I'm bullish, I may do a -1, +2, -1 below. So these are both long positions. They're both, I make money when it goes up. I make money when it goes down. Typically during earnings, you have this city, man, the volatility up here is huge. So you might be able to get 20 bucks for 3 and then 20 bucks to the downside for 3. So I may pay 6 bucks and with the potential for 20 bucks on either side. And all I need is for it to move more than the 6 bucks. And then there's all kinds of manipulations that I'll do. I like broken wing butterflies. And we could probably spend 2 hours just talking about why. All right, go back to the PowerPoint. So you'll have all these slides so you can play with this to your heart's desire. Ratio backspreads. These took me a long time to figure out. But look at the beauty of a ratio backspread. Same stock MasterCard. I'm going to buy one at the money for actually sell one at the money for $570. I'm going to buy 2 at $590. I'm going to collect a credit rather. I'm going to collect a credit of $2.57 per spread. And that's because the price of the short exceeds the price of the 2 longs. So if our current price is here and the market falls, I make money. If we do well, what happens is here is maximum loss because here is the short call. Here is the long call. No, this is the short, my bad. And here are the two longs. So we have to cover here's 20 bucks in this trade that I can lose. And the maximum loss is right here. But once I get 20 bucks more, I've broken even on the trade. And now I'm 40 bucks over here, so I'm at 610. And now I own unlimited upside. And what did I pay for that unlimited upside? Nothing. Nothing. I got it for free. Somebody paid me $2.50. Now, do I love this? Actually, I don't hate it because if the market drops, I get to keep the $2.50. I have tightly controlled how much I can lose here. It's got to move 40 for me to break even. And every dollar over $20, I start to have less and less loss. At plus 40 from the current price or from the lower strike price, I'm in the money. And then I have the bank's money running. I have no cost in this trade because I got paid $2.57. So you got to be willing to risk this little blip. But you get only upside if the stock falls because the market blows up. And if you can get through that window, only upside for free. In fact, you were paid to take that trade. I think these are interesting trades. You could also look at a 1 to 3. Now, in the 1 to 3, you're paying $347. But what happens is you're shorting one here. Oops. I can't believe I didn't even realize this was here, the drawing on Zoom. You're shorting one here, and you're buying 3 here. So your maximum loss here is going to be that same delta between the two strikes, which is 20 bucks. But since you're left here with plus 2, here you only have 1, and there's your minus 1, that gets you to your 3. You have 2 stocks, they only have to move 10 bucks, not 20 bucks, to get you to break even. So now you're break even at $600, not at 610. The cost of this trade is cheap, 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 $3.40. And now you got, for $3.40, if you're willing to digest this here, and it's going to be a little bit more of a loss than the last trade because you got a debit, not a credit, you got 2 calls basically for $3.47 or whatever, an unlimited upside. Here, if the market goes against you, you're out the price of the call. But you remember what a call by itself cost? It was $17.67, I think, or $14.67. Here you're doing it for $3. And I'm playing for the fences here. Low cost. I know how much I can lose. I know my max loss. I know my cost of entry. That's why I don't think options are necessarily risky. Let's clear that one. And I know you're getting tired of me, and I'm getting tired too. And my wife will come in 5 minutes and say, "You said you're done in 2." So I'm going to be done in 5 minutes. Synthetic. This looks exactly like owning the stock. Now, in this case, I had a debit of a little but. I have a debit of $323 per call. So the stock has to move $3.23 for it to make profitable. That's a lot different than $14.70. Now, how am I doing this? I'm buying a call and selling a put at the same strike price. In the setting of high volatility, the deltas pretty much knock each other off. And if I'm exactly at the money, it could be a small dollars to enter. I could get paid a few small dollars to enter, or it could be zero. It's a very cheap trade. Doesn't have to move much in my favor, has unlimited upside, but it also has unlimited downside. So cheap, it 100% equals the stock. Where do we make a mistake? I said I was willing to lose 10K. I was willing to buy 500 shares. So that means I could buy 5 calls. 5 calls are going to cost me 322 times 5. It's going to cost me $1,600. So I might be an idiot, and I've been that guy, and said, well, I can lose 10,000. So why don't I just buy 30 calls for $10,000, which is a lot better. So that controls 3,000 shares, which is a lot more than 500 shares for the same amount of money I'm risking. And that is why options are risky. Bad trade, because if this thing drops $5, I'm out $15,000. All right. It behaves just like the stock. If you were going to buy 500 shares, buy 5 calls. And if you do that, I am totally comfortable with the synthetic. Just don't get greedy on volume. Even though now you're risking to get into this only 322 bucks. It's not what you're risking. You're risking $500 every point that it drops. So you can't just assume that you're going to get out right here. Because what if the stock gaps down to here? So it's okay to do a synthetic. Don't ruin your life with the wrong size. That's why I look at how many I was going to buy with the stock. This should have the exact same risk, gap down and everything else, as if I bought the stock. But it's cheap, 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 cheap. And if you can manage just like you would the stock and not go crazy on size, I think synthetics are wonderful. But let's make your life easy. And that would be the next one, which is the chicken shit synthetic, which is really a synthetic call. And instead of being $14.70, you can buy this spread for 11 bucks. So it's a little cheaper to get in, means it has to move less to break even. You have a well-defined downside, but your downside's different than the call. The call, it's just the $17. No, it's got to be the difference in the strike prices, which is 10 bucks between your short put and long put, which helped pay for this long call to lower the price 4 bucks, 4.5 bucks. But your risk here is not 1468. Your risk is 10 plus 11 is $21. So in exchange for saving 368, I'm willing to take $7 more risk. So instead of 1470, I'm risking 21. This is a better trade. This is you can sleep at night. If the stock gaps down against you, you've capped your loss. If the market gets a black swan the day before expiration, you never have time to make it up, you've capped your loss. This is probably one of my favorite trades. And again, you've got a long call and a short put at the same price. So you're taking care of the deltas and you're buying a put that's out of the money to protect it. And you'll have less impact from the delta. And you can see here the delta is much less on the out of the money put than the in the money put. Those are my favorite trades. This guy, This guy's making a comeback. The married put. The married put says, I got a lot of money in my account. I just don't have an appetite for losing money. So the married put says, I'm going to buy 100 shares of stock, and that 100 shares of stock is going to cost me a lot of money. It's going to cost me $57,000. But I don't want to lose any money. So I can buy a 570 put, which means I have the right, but not the obligation, to sell my stock for $570 until January 16, 2025. So let's say you did that. It means you're going to pay extra 11 bucks for that put, which means to make money, you're going to have to move up $11. But your long position doesn't expire. Your long position can last a long time. Your short term only protects you until January 16th, end of market. But typically, I either die at birth and I get stopped out quickly, or I'm now making money on the trade. In which case, I can let my stops manage the trade, and the married put just protected me at launch. Where these come in really handy is I got married puts on a number of positions because of that 13-week new high, new low. I just smack puts on them at the money, paid the premium, which I can sell it back on Monday and not lose much money. But if we have a black swan hit us this week, I protected most of my positions that are long. Oh, by the way, I still made those returns by paying for premium. So married puts give you the right, but not the obligation, to sell the stock at the price you want to sell it at, which is your strike price. So here's what I did for you. Here is that analysis I showed you in the program. I didn't go back and check this, so there could be errors. But what I wanted to do, so MA 571, this is how much 100 shares cost, and I want to look at a minimum option spread of 20 bucks. I then listed the trades that we've talked about here, whether the components are, this is long, actually I already see an error. This one's long short because you're buying a long and selling a short, but it's a long position, that's fine. Butterflies long, these are all long positions. The ratio back spread, you're taking the short in the long. The synthetics, a long and a short, the synthetic call. So in reality, the butterflies are long, short, long, but they're directional, so I'll leave it where it's at. The synthetic call, and the married put. The cost of the trades, you can see how I consider the cost, the gains, the downside risk, and the margin impact. So here you got the trade cost to control 100 shares. The 1-2 back spread actually paid me for controlling it. Here's your upside, and here's your maximum downside. So I don't even have to look to the left. I really like 1467 unlimited, 1742 unlimited, 2347 unlimited, 2000 unlimited, 1338 unlimited. 4 really cheap trades to control 100 shares of stock with very little risk, and every one of those have unlimited upside. What is my goal? Find me an option trade that is relatively low cost to control 100 shares, where I have a well-defined, modest loss risk per 100 shares and an unlimited upside. Mission accomplished. Summary, define your A trade, develop tools to find them. There's tools all over the place. I think that this Market MRI Pro and now the Metastock add-on, I better go update my slide because this wasn't here the last time I did the discussion. And let's move this up. And now let's hit that. And now it is. And then trading plan, entry, exit, stop, money management, wash, rinse, repeat, success, and make money. For Market MRI Pro customer support, Praveen's at coding@marketmripro.com. If you have interested in the alpha scanner, it doesn't exist yet. So let me just take that out. All right. If you're interested in Market MRI Pro, the Metastock add-on, or anything I talked about, like I said, this wasn't a sales webinar. I wanted to teach. But if you don't have it and you want it, and a note to, is he still here? Since you made it the whole time, Lance, I'll give you 100 extra off because you own the other product. But don't tell anybody. Of course, I just announced it. If you're interested, but email me, can join the Google group, and I'll post the video and the slides there later on. I hope you guys learned something. That's what this is about. I'm paying homage to my inner Ian. He was the greatest. You guys have a great weekend, great holiday season, and come join me at the webinar we're doing in end of the 30th, and maybe you'll see some new things coming. And thanks everybody. I'm going to stop the videos and wish you the best.